Ticker of lies. In the summer of 2021, Vertex Dynamics Incorporated, a Silicon Valley tech startup, was the talk of Wall Street. Its stock had surged 230% in 6 months, following announcements of a revolutionary data compression algorithm said to change the future of cloud storage forever. Financial news outlets hailed it as the next Apple. But behind the ticker's spectacular rise was an empire of deceit, one that would eventually cost investors more than $3.4 billion. The mirage begins. It started with quarterly earnings that seemed too good to be true. Vertex reported profits 5 times higher than the previous year, despite having no major new clients. The company's CFO, Eric Mason, attributed the success to strategic efficiency and innovative accounting models. Analysts applauded. The market rewarded them. But one shareholder wasn't convinced. Laura Jensen, a financial analyst for a small investment firm in Boston, noticed inconsistencies between Vertex's financial statements and its SEC filings. She compared vendor invoices, cost of goods sold, and R&D expenses, and found they didn't add up. Her firm filed a request for clarification. Weeks later, she received an anonymous email. It read only 3 words: check the footnotes. The first clue. Jensen dug into Vertex's 10Q filing. In the footnotes, she found a line referencing revenue recognition from pending data licensing agreements. That single phrase set off alarms. Publicly, Vertex had never disclosed any data licensing deals. She sent her findings to the Securities and Exchange Commission, SEC. Within days, the case landed on the desk of forensic auditor Nathan Cole, a veteran investigator known for dissecting corporate fabrications. Cole's first move was to cross-reference Vertex's reported revenues with its actual client list. What he discovered was staggering. Over 62% of the company's declared income came from contracts that didn't exist. The engine of deception. Cole's team obtained internal accounting ledgers under subpoena. They revealed a network of shell clients, fabricated entities registered to mail forwarding addresses in Nevada and Delaware. Each had signed multi-million-dollar data licensing agreements, which were nothing more than templates with cloned digital signatures. To keep the illusion alive, Vertex's auditors, a mid-tier accounting firm, had confirmed these phantom clients during annual reviews, allegedly verifying documents provided directly by Vertex's finance department. Emails later showed Mason instructing staff to preload contract templates before each audit, ensuring consistency in fabricated client names. This wasn't creative accounting. It was organized financial deception. Stock market manipulation. The timing of the fake revenue spikes wasn't random. Cole's team noticed that every fabricated contract coincided with major insider stock sales. Between March and August 2021, executives at Vertex sold over $480 million in shares, all while releasing press statements touting record-breaking growth. The company's charismatic CEO, Gavin Troy, was the face of the hype. A frequent guest on business networks, he promised limitless scalability and AI-driven profits. But behind closed doors, he had instructed his team to artificially inflate the company's valuation ahead of an impending merger negotiation. It worked, temporarily. The whistleblower. In October, a mid-level accountant named Jacob Reese contacted federal authorities through an anonymous hotline. He had access to internal emails showing Mason and Troy discussing how to stage software demos using pre-recorded results. The demos presented to investors weren't live. They were simulations running from hard-coded data sets. Reese provided forensic backups, confirming that revenue data for the past 4 quarters had been manually altered in the accounting system. When confronted, Vertex's external auditors denied wrongdoing, claiming they had relied on management representations. But forensic log analysis revealed that their senior audit partner had personally approved emails containing doctored confirmations. The collapse. On December 3, 2021, the SEC filed an emergency motion to suspend trading of Vertex Dynamics stock. News spread rapidly. Within 24 hours, the company's market capitalization plummeted by 92%. Investors were furious. Pension funds, universities, and ordinary Americans who had trusted Vertex's growth story saw their savings vanish overnight. The forensic audit revealed that nearly $1.2 billion had been transferred to private investment accounts controlled by offshore trusts linked to Troy and Mason. Federal agents raided Vertex's headquarters. Both executives were arrested, along with 2 complicit auditors. The courtroom exposure. During trial, Nathan Cole presented a forensic visualization tracing the flow of money from fake clients to executive-controlled accounts. The chart stretched across an entire courtroom wall, each node a layer of deception. The prosecution introduced internal chat logs where Mason joked about printing revenue out of thin air. Troy, still in denial, claimed the scheme was industry-standard creative financing. But under cross-examination, he admitted that no licensing contracts had ever been signed. The supposed clients? All registered by a digital marketing firm secretly owned by Vertex's chief financial officer. It was the perfect illusion, until the auditors who enabled it were caught falsifying confirmations in exchange for bonuses. The scandal shattered investor confidence in tech sector auditing. Vertex declared bankruptcy in early 2022. Shareholders filed civil suits totaling over $3.8 billion in damages. Mason and Troy were convicted of securities fraud, conspiracy, and wire fraud. Their sentences totaled 55 years combined. But the story didn't end there. In a post-trial investigation, forensic teams discovered that portions of the embezzled funds had been reinvested into cryptocurrency wallets, an attempt to hide assets through digital anonymity. The recovery effort continues to this day. Nathan Cole, the lead forensic investigator, later said in a testimony before Congress, "The market runs on faith. Faith in numbers, in statements, in truth. But when those numbers become lies, the economy becomes a theater." Months after the case closed, an internal whistleblower file surfaced revealing that a senior SEC enforcement attorney had received prior tips about Vertex, but the complaint was dismissed for lack of merit. That attorney later resigned amid allegations of conflict of interest. Investigators suspected he had financial ties to one of Vertex's private investors. The revelation reignited debate about regulatory capture, when watchdogs become the watched. The moral and call to action of the story. Markets thrive on trust, not illusion. Every falsified report and every manipulated share erodes the foundation of honest enterprise. True innovation builds wealth. Fraud only borrows it until justice calls in the debt.